Hello everybody and welcome back to another True Potential Do More With Your Money podcast. It's episode 138 this week. We're going to be looking at market volatility and what's happening with the Bank of England and all the questions that you've probably got to wonder. We're going to be answering some of those today on the podcast, and for that we're joined by an extremely experienced and senior team here from True Potential's investment management team. We've got Raj, Chris and George back in the house today. Morning everyone.
Morning.
Good morning.
I mentioned we've got Chris back on. Now, Chris, there's been a bit of a search out for you lately. We've been wondering where you've got to. We haven't seen you for a few weeks. Tell us where you've been.
Yes, so I got married, which is quite...
I think that's worth a... Well, I don't know. I assume it's all going well.
No, it's all going well. It was a little difficult as both my wife and myself caught COVID 4 days before the marriage.
Oh, right.
Which is quite hard. So we had to write out to everyone. But it all went well. I've then been on a honeymoon. And I've then spent 2 weeks sort of travelling around the country, talking to all of our different advisors. So a very busy time.
There's a lot of news around at the moment. And obviously, if you watch the daily news on TV, you're hearing a lot of stuff at the minute. And it can be, a little bit depressing, frankly. That's not what we're about on this podcast. We're going to give it to you straight. Our job is to cut through all of the noise and all of the sort of hysteria that you'll often hear on the news when they've got, 90 seconds or 2 minutes to try to get across quite a lot of complicated stuff. We're in the good position of having, a good half an hour, a good 40 minutes on the podcast each week to cut through all of that and just give you the full picture. So that's what you're going to get today from the investment management team. So it's worth sticking with us today, and just we'll give it to you straight and tell you exactly what is going on and how it affects your money. So to get into that then, Raj, would you mind giving us a fuller, rounded update of what's been going on in the markets over the last week?
Sure, Peter. It was continuation of what we have been observing in the last couple of weeks. That we started the week with a little bit of volatility continuing from the Bank of England and also from the bond market, spilling into start of this week as well. So overall, all markets, as equity markets, were in UK and emerging markets, also in the US, they were all started on the very weakest run. Even oil, which was strong up last week, last couple of weeks, it was strong. Started giving some of those gains this week. Commodities in general has been on the weaker trend. Currencies have been fluctuating all across. We saw pound really making new highs and new lows overall. So I think that currency fluctuation continued. On the other side, we also saw Japanese yen, which we also big moves in Japanese yen as well. There was some verbal intervention from Bank of Japan yesterday, but that didn't help. So the overall weakness in Japanese yen continued. But then in the bond market has been the big story, and that continued to be a big story this week as well. We saw Bank of England coming in and continuing with its purchase overall. So I think that helped calm markets a bit down yesterday. So we saw a bit of momentum coming back in the bond market yesterday. And also yesterday we saw inflation print coming out of the US, which was hotter than expected. So initially market got corrected again. It reignited the fears that central banks in the US will have to increase their interest rates much faster. Mm-hmm. But again, we saw quite a big, remarkable turn yesterday towards in the afternoon session. We saw that markets reversing most of the gains. What has been behind that reversal yesterday? There were a couple of things. I think first is we saw a good earnings from companies coming out. Surprisingly, a couple of big names, like for example Delta Airlines came out surprised quite markedly up. So that gave us some of the boost, to a much needed boost to the markets overall. Then we also saw some of the short covering in the market, which was technically positioned, because over the past few weeks we have been hearing these stories. Market participants have been betting their markets to remain volatile, and short covering was a big part. But then also maybe in the UK particularly, we saw some of those news coming out that there's a potential for government to rein back their fiscal spending power, and potential for taxes to be raised again. which is probably some of the U-turn. So probably that also helped ease pressures in the bond market. So I think those a confluence of those factors probably help change the turn in the tide yesterday. And it was a remarkable move that at one point Dow Jones in the US was down 500 points, and it ended up around 600, 800 points up. And so it was a remarkable turnaround. So overall momentum has been good. So what Bank of England and central banks have been doing probably is helping to calm those nerves down overall.
Yeah. Chris, as we mentioned, you've been away for a while, but part of that's been out on the road talking to advisors. Can you just give us your perspective, maybe looking back over the last few weeks, and just what your view of where we are right now is? I mean, you've got time to do this in some depth, so we're interested to hear your perspective.
Yeah, absolutely. I think if we think about where we are right now, we have experienced some really significant moves in asset prices so far. So if we look at, say, equity markets, global equities, so basically company shares, global equities are down around about 23% year to date in local currency terms. If you look at bond markets, see a huge amount of volatility within bond markets. You see in bond markets, depending on which index you look at or which individual bond you look at, down around about 20% overall. Now, the reason why I'm saying this is just really to kind of frame where we are. We've experienced very significant moves, and actually there's probably clients watching this, looking through the news, reading about the Bank of England, reading about inflation, reading about all the different things that we're looking at all the time, and probably becoming quite nervous. It's been quite an uncomfortable ride so far this year. But I think the key thing for me is actually a lot of that is already priced into markets. The reality is markets are pricing intra-second all the time, and they're looking at all the different data points that are coming out, and they're looking at sentiment, they're looking at everything moving forward as well. And actually what you can see there is we've experienced big moves. So I think for me, maybe just commenting on a kind of few things that people are thinking about right now. So maybe just talking a little bit, building on what Raj was talking about around the Bank of England. Obviously we've seen a lot of instability within bond markets, within UK GILT, so UK government bonds, so bonds that are issued by the UK government, also UK index-linked gilts as well there. Obviously all of that started from the kind of mini budget, the fact that we were going to get £43 billion worth of unfunded tax cuts, the fact that there weren't forecasts there. And then what that then led to is instability within pensions. But I think this is a really, really important point. It's instability within final salary pensions.
Yeah.
So they're the pension that many years ago lots of people used to get from their employer. It's absolutely not something that is offered here at True Potential.
So just to be clear on that then, if clients watching this have got a pension with True Potential, that's not one of the pensions that you're talking about, these final salary defined benefit, the ones you're hearing on the news that Robert Peston and others are talking about. That's not us.
That is exactly it, yeah. And I think that's a really important point to make. I mean, I was actually looking at some stats. I was just on the train before coming up from London. So if you look at final salary pension schemes right now in the UK, the latest data that we have, and this is from the Financial Times, say that they're around about 71% invested in UK government debt. You compare that to our balanced portfolio, which has around about 2.6% in UK government debt. I think the second thing as well is, final salary pensions use leverage. So they leverage up that government debt overall, and that's what's led to the instability. So obviously if you've got leverage, you have to provide collateral on the back of that. If then gilt yields spike up, you need to provide more collateral. And that's when you start to see the rumours of pension funds becoming potentially insolvent. So, for me, what do we offer? Well, we offer something that is a genuinely diversified product. It's diversified across asset class, across region overall, and is completely different to what is out there within defined benefit pension schemes right now. If we look at, where we're going with the Bank of England, as Raj said, things feel a little bit calmer today. It's been a very bumpy ride, but what I would say as well, you're starting to see yields on not just government debt, but actually yields on all fixed income at such high levels that you're seeing really good entry points coming through. You're seeing really favourable opportunities.
We should just say we're recording this on Friday morning as well, because there is a lot going on. So but that's as we talk to you now, it's as you say, there's been a lot of volatility around. But the diversification, George, that we talked around on the podcast last week, that's really when it comes into its own, doesn't it? It's the opposite of having all your eggs in one basket. So, if there are choppy waters, we're on a. I'm trying to find a metaphor about a big ship that can sail smoothly, but you know what I mean. Diversification allows you to ride that storm.
Yeah, absolutely. I mean, as Chris alluded to there, a lot of the volatility's been within the UK gilt market. So, by moderating your exposure to that part of the market and diversifying it in other government bonds around the world, corporate bonds, and also just thinking about the way in which that creates opportunities. Chris mentioned that opportunities are there. Essentially, we've seen markets which have been moderating through the course of the year quite aggressively, but earnings remain robust across companies, and on that basis, the valuation which you're paying for the company is stronger. So therefore, as a multi-asset investor, you're actually on a better foot, and you've got a good opportunity set because the expected return across assets as we look forward is greater than what it was at the beginning of the year.
And in terms of the breadth of the portfolios, I mean, we talk, in excess of over 100,000 different holdings. So if I invest £1 or 100 or 1,000 or whatever into your portfolios, that is being distributed across many, many thousands, over 100,000 individual different shares. I mean, that is a huge breadth of diversification, correct? Yeah,
absolutely. And, it's the reasons why, when you hear of particular names being mentioned in the press, what's the impact of that on the portfolios? Well, it's likely to be relatively limited unless there is a contagion impact across a sector or the whole index picks up sentiment from that. But yeah, diversification in terms of diversifying the type of companies which we're holding, where they're listed, and also not just thinking about buying it in terms of a stock or an equity, thinking about the bonds, the debt which we can purchase as well. So the type of bonds which our managers are picking up at this point in time with yields where they are is very attractive. And our managers who have been positioning more defensively through the course of the year, and by defensively, what I mean is moderating their exposure to equities, moderating their exposures to bonds, holding more cash, have had that opportunity to put that cash back to work at this point in time. So marrying up the opportunity set and the valuation, there's a few different examples there of entry points which our managers have taken for our clients.
I think one other thing as well, just maybe building on what you were saying there, George, is we talk about diversification and we talk about diversification by asset class. So that we're talking around, company shares, we're talking about bonds, we're talking about cash. We're also talking about alternative assets as well. And actually, I think one thing that's really worked for the portfolios this year has been the alternative assets. So one of the things that I was talking to our advisors about over the last couple of weeks is a product we have which is called Trend. So Trend looks for trends. So those trends could be...
Took you a long time to come up with that name for it, didn't it,
Chris?
It did,
yeah, it's a good name. Looks for trends, so they could be like short equity, short bonds. It believes that there's momentum behind those trends, and those trends will continue. And actually, if we look at that product that it's held, we've got more than one product actually within Trend as an asset class. But the main product we hold's up around about 42% year to date. Obviously, that's not going to help portfolio performance to suddenly make it positive when you've got both equity and bond markets down. But what it does help is provide diversification, and it does help provide a cushion in more challenging times.
We had a question in, Raj, from one of our viewers asking around if you in the investment management team want to, because obviously we talk about active management. In other words, you're able to make decisions on the investments that the clients have got with us in their best interests. So if you wanted to do that, if you wanted to say, move out of one asset class or one geography into another, can you do that, and how easy is it for you to do that?
I think this is precisely the point of diversification what George and Chris alluded to. I think we work with these well-established, globally diversified managers who are sitting in different parts of the world and have their focus in different parts, in the parts of the market, not only geographically, but also instrument and their expertise. And I think this is an important point, given that we are sitting in the UK today, but our exposure to UK assets is very small in comparison to what you will find in the likes of LDI or the final pension scheme. So I think we are always in conversation with our managers on a monthly basis, on weekly basis. We are getting all the inputs from our managers, and if we see we want to move our portfolio a little bit towards US equities or non-UK assets. So we have been gradually shifting since the start of the year. That's what our shift has been. We've been moving our portfolios towards sovereign bonds, which are non-UK sovereign bonds, to currencies diversification as well. So we use a breadth of our managers available on our platforms like Goldman Sachs and UBS and Allianz, who have got global presence, to be invested with them in a globally diversified portfolios. And we have been invested in, for example, in Close Brothers, for example, has a large US exposure to equities in the US. So I think those are the measures we use typically to move our portfolios. But again, the one thing which George mentioned is like having cash at the right time. So we have been running, and our managers have been running a slightly high cash overall balances. Now it's providing our managers and us an opportunities to buy these assets globally, assets which are at much cheaper level, which sets it's nicely for the future, for next 12 to 18 months. If you look out, the potential return from these assets have never been greater than last decade or so. So potentially investment grade, high quality investment grade, like your likes of BAT or likes of BT are yielding around anywhere between 6 to 8%. These were not yields available. If you go back in December, those were closer to 3-4%. You're actually getting double paid with the highest quality balance sheets. So I think those are the opportunities our managers and us are evaluating with the cash which we have been building. So, and this is not only in the UK. You can go in the US, a highest quality company in the US, you can buy and still get 7-8% yield. So I think
you often are too modest to say it because you're nice people, but you're obviously very professional. But you manage £22 billion of clients' assets, clients' money. And that, that just trips off the tongue, but we should just think about it for a second. £22 billion. You don't get to be that big. You don't get to have that much money unless you're good at your job. And clearly you clearly are, which is why a lot of clients trust us. Everyone in this building, by the way, has skin in the game. We're all invested. We're all invested in our own portfolios. This very week, in fact, a couple of days ago, I decided to do an impulse save and straight in. And actually, I'm so pleased that today markets are up, and that's probably growing a bit as well. So that's great. But I mean, I'm in for the long term, and so everyone who invests, you do it knowing that you're in for the long term. Investing is a long term, medium to long term game, and we talk in terms of 5 years or so. But I mean, right now there is an opportunity. You talked about markets being down this year, which clearly they are, but that means I'm effectively walking into a shop and buying a suit maybe for a 20% discount on what it would have cost me previously. So the impulse save that I did in the week, I'm getting those assets, those holdings at a much cheaper rate. So that when the recovery comes, which of course, if you look back over markets it always does. I'm getting in at a lower rate. I mean, have I made a good move there, Chris?
Yeah, I mean, look. Firstly, thank you for investing into True Potential portfolios. As you said, basically everyone in the office is invested within the True Potential portfolios. I was calculating this last night. I think 80% of my wealth is with True Potential. We all have what we call skin in the game. For me, I think that's incredibly important. As a fund manager, if you don't invest in what you run, then there's something very, very seriously wrong with what you're doing. But I think from an opportunity perspective, the reality is that asset prices are a lot cheaper now. I agree with everything that you're saying. What we look at, and again, this is some of the things that I was talking to the advisors around, is we've been looking a lot at valuations compared to the last 20 years. So basically, what were the kind of average valuations within equities or within fixed income, and looking at the individual asset classes to see, where is the valuation opportunity. And actually what you're seeing is in a lot of asset classes, there's valuation opportunity. And the reason for that is because of the big moves that we've seen so far this year. So again, for me, are our managers taking advantage of that? They are. Managers right now generally have quite a bit of cash on the sidelines, but that cash has been coming down. Probably a good example is Stephen Haid. He runs our True Potential Close Brothers Income Fund, so part of the balanced and cautious income portfolios. He's taken cash down by probably about 7-8%. And that's just because he's finding so much opportunity. So he's found 14 bonds yielding over 8% in the past few months, which is an incredible opportunity that he's finding coming through. And it's not just him, you know, it's our other managers. We're seeing good opportunities for the long term. I think the key thing here is, you know, we're long-term investors. You know, the reality is that, you know, the short term so far this year has been incredibly uncomfortable for everyone, for us, and clearly for our clients as well. But the reality is, you know, if you look at that chart of, I don't know, like US equities or world equities, you take it back as far as you can. At some point, this will just be a little blip.
Yeah.
And
well,
it will just continue
March,
going up.
Chris, March 2020, COVID.
Yeah,
great
exactly,
example.
yeah.
Anybody can go back and look at any of the indexes, and of course, there's a big drop when COVID strikes in March 2020. But then within a few months, it's back above where it was before that.
Yeah.
You know, so you're always going to get these drops. That's markets for you, but the bounce back comes. What the difference is, and it does annoy me a bit, is you watch, you know, you do watch the news on TV, and as I said at the start, they're trying to cram pretty, you know, complicated stuff into 2 minutes. And of course, they're very quick to tell you when markets are down 1% or 2%. You never hear the same news when they're back up 2 or 3% when they bounce back higher.
Yeah.
You never get that.
I think it's also important about how to ride the volatility, and I think it's as Chris mentioned, some of these bonds, some of these opportunities are so large that you're getting paid today to hold, even for if we see some volatility in the markets. Let's say if bond yields spike up a little bit from here on, at least you're getting paid to hold that, to ride that volatility. If you go back in December, for example, November, December, you were only getting paid less than 1% for holding 10-year gilts. Now you're for the same bond, you're getting paid 4-5% of that. So I think it's, even if we see a little bit back up in yields as well, you're being compensated in total return perspective as well. You will better off holding that bond. So I think it's that aspect, that opportunity costs have actually become more favorable to holding these financial assets and being rewarding to the overall portfolios overall.
Yeah, I mean it is true. You know, when I was doing that impulse save the other day, you know, I mean, your thumb does hover over the button for a second or two just while you think, you know, is this? But then, of course, that the problem is that you're trying to time a market, and that's impossible to do. Yeah. And so I know, yes, of course, you know, you think, and then you think, do you know what? I'm in this for the long term. I'm in this for that. That is the reason. The whole point of investing is I want to see that money grow over the next few years. I'm not bothered about the weather. I'm thinking about the climate. I'm in it for the longer term. And you think, you know, absolutely right. And as I say, you know, took less than 2 minutes to do it. That's grown. I can see already in my app that is grown. And that's what we're all about, isn't it? You know, in it for the long term. Treat people like adults. They've made the decision to invest. That means they've accepted that volatility is an ever present in markets, always will be. And it's when markets are low that you earn your money by finding the opportunity. And that's what you're doing right now, isn't it?
Exactly. I think, you know, yesterday was a great example of that. You know, markets are volatile, no getting away from that. Yeah. But take what happened over the last 24 to 48 hours. Essentially, 2 interest rate hike expectations have dropped out of the UK. What that meant is yields have come down on UK government bonds. That means that you've made a positive return over that short space of time from a government bond. And then on the other side of the water, you had the US market, where you had an inflation print which came out, you know, still elevated, came out 8.2%. Some were expecting it to be 8.1. It was coming from 8.3. No real change there. It was actually a bit broader than what people thought. But you get a market where the US goes from being down 2% on the morning to up 2% in the afternoon. And it's a demonstration of, yes, there's volatility, yes, there's a lot of news going on, but that's how quickly the market can change. And you've got to think about what's your goal, how long are you investing for, and essentially leave it to the experts.
I think that is a critical point. I think it's yesterday was a great example where to time the market, you need to get 2 timings right. First of all, to get at the right time out, and then to time it back in as well. So getting one timing right is difficult. Imagine getting two times it right. It's incredibly impossible. And hence, I think it's important, and the philosophy is, and we believe at True Potential, is that having this long-term horizon, goal-based investing, and setting those goals right, and being invested for long term is the way to manage a portfolio, and participate in the overall growth in the financial assets and economy is the only way for us to manage.
And, you know, as I say, you know, getting into the markets now, when the bounce back comes, which it will, you've got more upside because you got in when it was cheap. So it's that's exactly what we should be thinking about. Chris, let's look into your crystal ball. I'm going to put you on the spot since this is your first podcast for a while. How do you see the outlook looking ahead? I mean, can you look towards the end of this year and give us any sense of where you think things might be going?
Yeah, sure. I think it would be wrong of me to say that everything will be perfect from this day onwards. And I'm not going to say that in any way. The reality is that there is a lot of challenges economically right now, and that will lead to volatility. That volatility, however, will also lead to opportunity. I think if we start to look further out, though, that's where you start to see some improvement coming in. I think what is kind of driving that in my mind, it's what we were talking about before. It's all about the moves we've seen so far. The moves we've seen so far are so significant that it's bringing through that opportunity. It's bringing through investors who are holding a lot of cash to say, okay, do you know what? Things have moved so much now. Now's the time for me to start to spend a little bit of that cash. If you start to see things become a little bit choppier, maybe, you'll start to see more investors come online as well. So for me, long-term investing, it's the place to be. It's the right way to invest money right now to offer what we want to offer, which is really good risk-adjusted returns overall.
I mentioned the assets on the portfolio, on the platform, 22 billion. Should also say that 1 in 5, about 20% of UK financial advisors trust us to look after their clients. 1 in 5 UK advisors is using True Potential. You don't get that scale unless you know what you're doing as well. So you've been on the road for the last couple of weeks, Chris, talking to those financial advisors. What's their mood? What are they saying to you?
I think they're all saying the same thing, which is, they're having a lot of conversations with their clients. I think their clients are quite nervous because of what's been happening over the past few months. And I think the key thing that they wanted from me is really to understand, what are the opportunities, exactly what we've all just been discussing right now. How do we see things pan out moving forward? Exactly what we've just been discussing right now. I think other things they've been thinking around is, again, a little bit around pensions. So I talked before around, we're not providing final salary pensions. We're providing defined contribution pensions. It's a completely different market to what all the news are talking about right now. And I guess probably the key questions that they were asking me a lot about was the UK government. Where do we go from here? Which is probably a more challenging question to answer, and that question changes every single day with various different U-turns coming through. But I think, for me, it feels uncomfortable right now because we're in the UK. There's obviously a lot of challenge with what's happening with the UK government, with the Bank of England. But I think, the reality is you're not just invested in the UK, you're invested worldwide. And actually, the UK doesn't technically really drive much what happens worldwide in stock markets. It tends to be what's happening, say, in the US or maybe within China.
I think it's just another, talking to a couple of advisors, I think it's incredible they've been engaged with their client in advice. I think it's an important, and one way we got positive feedback from some of the advisors that the amount of public communication True Potential is producing on the morning markets, the podcast, they are using that more and more with their clients, and what is that helping them is to go back to the clients, guide them to these things, and making them that these are the experts, these are the people who are on daily looking, breathing in and out of the market volatility. And I think they are using that as a very, very important tool of engaging with their clients and giving them information. And I think that probably has helped, what I could gauge from that, help them ease the nerves for some of the clients as well.
Yeah, exactly. Well, it's worth saying again, you watch the news or pick up a paper, you're seeing, in general, one side of a coin. There is another side to that coin, and you've explained it, and these guys hold those coins, and we can trust them because they know what they're doing. And you certainly, I don't need to have confidence off you because I work with you every day, but I'm sure our clients have listened to what you've said, and as I say, they're in this for the long game, and it's certainly very reassuring. If people want more reassurance, Chris, how can they get in touch with you and your team?
Yeah, absolutely. So I think the very best thing that you can do is subscribe to the YouTube channel. So within that, you'll obviously receive the podcast, you'll receive Morning Markets, We provide a monthly portfolio update as well. So again, there's lots of ways that we communicate with clients. A lot of content that we produce. For me, I've been in fund management for 23 years. The very worst thing that you can do in turbulent times is to go quiet. That is the very worst thing that you can do. You should be on the front foot. You should be out there contacting your clients, providing communication, and that's exactly what we've done this year. If anything, we've stepped up the communication,
completely,
and that's so important.
And another point is speak to your advisor.
Absolutely,
get in touch with us. We're here. We're not going anywhere. We're here. We can have a chat anytime, can't we? And reassure people and answer their questions. One question we had, George, is what's a GILT? In 10 seconds.
GILT is a UK government bond, essentially. If the government wants to finance government spending, they can use the Debt Management Office to issue what you called is a government bond. It's essentially an IOU. You buy it from the government promised to give you a set amount back, and along the way they'll pay you interest. The actual term for that's called the coupon. The coupon tends to be fixed. The market price of the bond is the aspect which will move. If you put the two together, you get the coupon on an annual basis, and the market price, that's where you get the yield. The yield and a price move inversely. So when we're talking about, just to set the language here, if we're talking about bond yields moving higher, that tends to be negative for the price. But if bond yields are coming down, as we've seen through the last 2 days, that's positive for the price. So the two move inversely to one another, but essentially you're holding government debt.
Okay. So a government bond.
Yeah.
That was more than 10 seconds, George, but I'll let you off.
That was excellent.
That was excellent.
That was better than I would have done.
We'll just clip that bit and send that off to the news channels and everything, because that's the best explanation I've heard in the last 2 weeks of what a GILT is. Right. Thank you very much for all your time today, and I think that's been incredibly useful. So. Thanks very much. I'm going to ask one last question, which is, I'm not going to ask what you're going to have for your dinner tonight or what you're doing this weekend. I mean, whatever. What you're doing, this is when you earn your corn. Markets like this and times like this is where you guys really come into your own. What are you doing after this podcast? What's the first thing you're going to do next, Raj, after this podcast today?
I think the first thing was, as things are volatile and moving very fast, looking at the markets, what's happened in the markets, if there's important development which we may need to take into account for making any changes or informing, and also looking for communicating, and if there is any communication needs to be going back to clients, their questions or coming from advisors. I think that going back to replying to that will be my first thing.
Okay.
I've got a call with one of our appointed fund managers. Going to hold them to account in terms of their performance. Their performance has been strong because they've been using a number of those alternative style products which Chris referred to earlier. But what I want to know is how it's going to behave as we move forward. So we've got the performance locked in, but what are they going to do for our clients as we look forward?
You need to get back home and see your good lady. You haven't been on the road on tour for a couple of weeks, don't you? Is that what you're doing next?
I'm not. I'm actually doing more filming. So again, another piece of communication, which will be Morning Markets, which will come out a little bit later today. So that is my next job. I think they're going to really try and get the worth out of me today, because I've not been doing any filming for the last 5 weeks.
Okay. Well, as Chris said, the best way to see that, and not just today, but any day, is to hit subscribe to our YouTube channel, because you'll get the podcast, you get Morning Markets, and we're here anytime you need to speak to us. You can get in touch with us here at head office. So stay in your seats, back yourself, back that decision you made to invest in the first place. Trust the process, trust these guys, and you won't go far wrong. For now, thanks for watching. We'll see you next time. Bye for now.
Thank you.
If you're interested in taking your investing to the next level, or would like to know more about the options available to you when you retire, then download our free guides to ISAs and pensions. These are available in the video description below.